If you get your director's loan account wrong, your company could face a 33.75% tax charge. But if you understand it properly, it's actually one of the most tax efficient ways to extract money from your property company. I'm a property accountant and a portfolio landlord, and in this video I'm going to explain what a director's loan account is, how it works, and how to maximise yours whilst avoiding the common tax traps. So firstly then, what is a director's loan account? Very simply, it's a loan from a director of a company into their company. Take a property investment company as an example. Property is a cash-intensive business. Directors often need to inject money into their company to fund deposits, legal fees, refurb costs, and other purchasing expenses. The director has to put their own money into the company to pay for these costs, and that money becomes a loan to the company. The company then owes that money back to the director. That means at any point in time, the director can extract that money back out of the company and into their personal bank account. The repayment is not subject to any personal tax. Unlike salary or dividends, a repayment of director's loan is simply the company returning money that has already belonged to the director. That's why, when managed correctly, it can be one of the most tax efficient ways to withdraw funds from a property company. It's also important to remember that your limited company is a separate legal identity to you as an individual. It's not just you trading under a different name. So therefore, whenever money moves between you personally and the company, it has to be recorded correctly. That's what a director's loan account does. It keeps track of what the company owes you or what you owe the company. Because property is capital heavy, over time a portfolio landlord may inject significant amounts of funds into their company. They then refinance properties, recycle deposits and continue building your portfolio. But quite often a substantial amount of capital will have to come from your personal bank account to pay for property purchases. Over a number of years, that director's loan balance can easily build up into six figures. We could be talking several hundreds of thousands of pounds owed by the company back to you, the director. For that reason, particularly for property investors, it's important to think ahead and plan how and when you'll extract those funds. It can even form part of a longer-term retirement strategy once you step away from your employment. Tracking the director's loan account itself is fairly straightforward. The balance is made up of money paid in, money taken out, and business expenses you've covered personally. When you transfer money into the company, clearly tag it director's loan. When you repay yourself, tag it in the same way. And make sure you're using accounting software such as Xero, which can make tracking your director's loan account really straightforward. If you pay for business costs personally, these can also be added to the loan balance. Your accountant can help you with the mechanics, but it's important that you understand the figure yourself. In simple terms, it's just money in, less money out. Money in increases the balance, money out reduces it. Where problems start is when directors stop checking the balance. They assume there's money available in their director's loan balance. They continue withdrawing the funds. When it comes to the year end, their accountant tells them that their director's loan has gone overdrawn. The director's loan account becomes then overdrawn, meaning you've taken more money out than you've put in. You owe the company that money back. At the end of your accounting period, if the balance remains overdrawn, you have 9 months and 1 day to repay it. If you fail to do so, the company faces a tax charge of 33.75% on the outstanding balance, which is a significant amount. If you were £50,000 overdrawn and didn't repay it in time, you could be looking at a tax charge of over £16,000. That's a material hit to cash flow which could have been avoided. If you're subsequently able to repay, the tax charge can be repaid back to you. Key point is to avoid becoming overdrawn in the first place. And if it does happen, deal with it within that 9 month and 1 day window. Another trap to be aware of is bed and breakfasting. Some directors think they can simply repay the loan and immediately withdraw the same amount again. HMRC are aware of this. There's a 30-day rule in place which prevents that strategy from avoiding the tax charge. It's also worth noting that on the balance sheet, the director's loan will appear as a liability if the company owes you the money, or as an asset if you owe the company money. Large overdrawn balances can raise questions from lenders, so it isn't purely a tax issue, it's also one of credibility and overall control of your business. Finally, there's a question of charging interest. If the company owes you money, you are allowed to charge a commercial rate of interest on that loan balance. From the company's perspective then, any interest is tax deductible and reduces the corporation tax position of the company. However, the company must deduct 20% tax at source and submit a CT61 to HMRC. You also need to consider your personal tax position. Basic rate taxpayers will have a £1,000 saving allowance. High rate taxpayers have £500. Beyond that, personal tax will apply on any interest. Charging interest can make sense in certain circumstances, particularly for someone transitioning out of pay-as-you-earn employment, but it needs to be considered as part of your wider tax position, not in isolation. So in summary then, a director's loan is simply a record of any money you've put into the company and any money you've taken out as a director. You must avoid becoming overdrawn. If you do, repay it within 9 months and 1 day to avoid the 33.75% tax charge And if you're considering charging interest, make sure it fits in with your overall tax strategy. Hopefully you found this video useful. If so, you're going to love this next one where I talk about whether you should invest in property in your own name or in a limited company. Watch the video now.